a comparative evaluation of Bitcoin and central bank digital currencies, examining their efficacy in the contemporary financial landscape. The advent of digital currencies has prompted a paradigm shift in the global financial landscape. Bitcoin, the pioneering decentralized digital currency, has garnered significant attention and adoption since its inception in 2009. In response, central banks worldwide have begun exploring the development of their own digital currencies, commonly referred to as central bank digital currencies, CBDCs. This video aims to provide a comprehensive comparative evaluation of Bitcoin and CBDCs, examining their efficacy in the contemporary financial landscape. We will delve into their underlying technologies, the motivations driving their development, their potential benefits and drawbacks, as well as their implications for financial stability, privacy, and monetary policy. First, what is Bitcoin? Bitcoin is a decentralized digital currency built on blockchain technology, which allows for peer-to-peer transactions without the need for intermediaries, such as banks or governments. It was introduced in 2009 by an anonymous developer or group of developers under the pseudonym Satoshi Nakamoto. Bitcoin's primary innovation is its decentralized nature, which is achieved through a consensus mechanism called proof of work, enabling a secure and trustless transactional environment. Second, what is a central bank digital currency, CBDCs? CBDCs are digital forms of a nation's sovereign currency issued and controlled by its central bank. They represent a digital equivalent of cash, with the central bank acting as both the issuer and the regulator. CBDCs can be designed as wholesale or retail, with wholesale CBDCs being used for interbank transactions and settlements, while retail CBDCs are designed for use by the general public. The development and implementation of CBDCs have been driven by several factors, including the declining cash usage, the need for financial inclusion, and the desire to maintain control over monetary policy in an increasingly digital world. Blockchain technology and Bitcoin. Bitcoin relies on blockchain technology, a decentralized, distributed ledger system that records transactions in blocks linked together in a secure and tamper-proof chain. The key features of blockchain technology that underpin Bitcoin's functionality include decentralization, immutability, and transparency. Decentralization is achieved through a network of nodes that collectively validate and record transactions, while immutability ensures that once recorded, transactions cannot be altered. Transparency is facilitated by making the entire transaction history publicly accessible, allowing anyone to trace and verify transactions. Distributed ledger technology and CBDCs. CBDCs can be built on various types of distributed ledger technologies, DLTs, such as blockchain, directed acyclic graphs, DAGs, or other consensus mechanisms. While some CBDCs may employ similar technologies as Bitcoin, central banks can tailor the design and functionality of their CBDCs to meet specific policy objectives. For instance, CBDCs can be designed with varying degrees of centralization, privacy, and access controls, depending on the goals and preferences of the issuing central bank. Bitcoin emerged as a response to the global financial crisis of 2008, with its ethos, seeking to create a decentralized, censorship-resistant, and borderless digital currency that operates independently of traditional financial institutions. The key drivers behind Bitcoin's adoption include its utility as a store of value, a means of exchange, and a hedge against inflation and financial instability. The development of CBDCs has been driven by several factors, including the declining cash usage, the rise of digital and mobile payments, concerns over the increasing prominence of private digital currencies, and the need to maintain control over monetary policy in an increasingly digital world. Central banks also aim to enhance financial inclusion, improve payment efficiency, and bolster financial stability through the implementation of CBDCs. Benefits and drawbacks. Bitcoin. Benefits. Decentralization. Bitcoin's decentralized nature reduces reliance on centralized financial institutions and governments, fostering financial autonomy for users. Borderless transactions. Bitcoin enables fast, low-cost, cross-border transactions without currency conversion fees or intermediaries. Censorship resistance. Bitcoin transactions cannot be easily censored or controlled by governments or third parties, promoting financial freedom. Limited supply. Bitcoin's capped supply of 21 million coins makes it a potential hedge against inflation and fiat currency devaluation. Drawbacks. Volatility. The high price volatility of Bitcoin limits its utility as a stable store of value and medium of exchange. Scalability. Bitcoin's current transaction throughput is constrained by its block size and confirmation time, which can lead to delays and higher transaction fees during periods of high network congestion. Environmental impact. Bitcoin's proof-of-work consensus mechanism consumes a significant amount of energy, contributing to environmental concerns, albeit many of these are misplaced. Illicit activities. The pseudonymous nature of Bitcoin transactions has been exploited for illicit activities, such as money laundering, terrorism financing, and tax evasion. CBDC benefits. Financial inclusion. CBDCs can provide greater access to digital financial services for unbanked or underbanked populations, efficiency and cost reduction. CBDCs have the potential to streamline payment processes, reduce transaction costs, and improve settlement times. Monetary policy. CBDCs offer central banks more effective and precise tools for implementing monetary policy, such as programmable money and negative interest rates. Financial stability. CBDCs can enhance financial stability by providing a risk-free digital payment instrument and reducing the reliance on bank deposits. Drawbacks. Privacy concerns. CBDCs may raise privacy concerns if central banks have the ability to track and monitor individuals' transactions. Impact on traditional banking. Widespread adoption of CBDCs may reduce the role of commercial banks in the financial system, potentially affecting credit availability and financial stability. Technical challenges. The implementation of CBDCs requires overcoming various technical challenges, including scalability, security, and interoperability with existing payment systems. Disintermediation risk. If not properly designed, CBDCs could lead to disintermediation risks, with a sudden shift of funds from commercial banks to CBDCs, potentially destabilizing the financial system. Implications for financial stability, privacy, and monetary policy. Bitcoin, financial stability. While Bitcoin's impact on financial stability remains limited due to its relatively small market size, rapid growth or integration into the mainstream financial system could pose potential risks. Privacy. Bitcoin offers a degree of privacy through pseudonymous transactions, but lacks the anonymity provided by cash. Monetary policy. Bitcoin operates independently of central banks and does not directly affect the implementation of monetary policy. CBDCs. Financial stability. CBDCs can both enhance and pose risks to financial stability, depending on their design and implementation. A well-designed CBDC can provide a risk-free digital payment instrument and reduce reliance on bank deposits, while poorly designed CBDCs may lead to disintermediation risks. Privacy. The level of privacy afforded by CBDCs depends on their design, with central banks facing a trade-off between privacy and the need to combat illicit activities and maintain regulatory compliance. Monetary policy. CBDCs offer central banks more effective and precise tools for implementing monetary policy, such as programmable money and negative interest rates, potentially enhancing their ability to achieve policy objectives and maintain economic stability. In conclusion, the rise of digital currencies, both in the form of Bitcoin and CBDCs, has disrupted the global financial landscape. Bitcoin offers decentralization, censorship resistance, and potential protection against inflation, it also faces challenges related to volatility, scalability, and illicit activities. CBDCs present opportunity for financial inclusion, improved payment efficiency, and more effective monetary policy. However, CBDCs also raise concerns about privacy, the potential disruption of traditional banking, and technical challenges. Both Bitcoin and CBDCs possess unique attributes and potential advantages. However, their efficacy ultimately depends on their ability to address the challenges and risks they present. Thanks for watching, and make sure to subscribe to the Bullseye Offensive on Substack. Goodbye.